Welcome to MBPA's Health Care Reform Conference. Today our goal is to help you leave here with all, as I said, all your reform questions answered. While this piece of legislation is going to change over the months to come and most likely tomorrow, we want to get our members up to date with new information, hopefully before it comes out. After this conference, our goal is to keep you up to date and walk you through your options in servicing clients or implementing reform in your own business. It's a difficult task, so again, hopefully we help you through that today. I'd like to thank our sponsors this morning, some of which hopefully you visit their booths in the hallway. Basic, St. John Providence Health System, Blue Cross Blue Shield of Michigan, Raymond, Clark Hill, and the 101 best and brightest companies to work for. Again, as I said, they are in the lobby, so please stop by and say hi and see how they might be able to help make your business better. For those of you who are unfamiliar with MBPA, we have over 100 programs and 30 events that we do every year. We make our members' businesses better through networking, financial savings, business knowledge, legislative influence, and we will help you get through healthcare reform. Jennifer Werner is going to be giving you a demonstration later of our Healthcare Reform Connect. With that, I'd like to introduce Jennifer Werner, our Vice President of Insurance Operations, and she's going to lead this session. Good morning, Jennifer.
I'm not as tall as Geary, so. Good morning, everyone. I'd like to welcome you to the session on employer mandates, a detailed look. I have our speaker this morning, who is Kristi Gauthier, who's a senior attorney at Clark Hill and concentrates her practice on employee benefits law. Kristi's a frequent speaker on healthcare reform compliance. So I'd like to introduce Kristi, and she's going to go over the presentation this morning with you, and then we're going to take about 5 minutes at the end. I'm going to show you our new tool on Healthcare Reform Connect. So let's get started this morning. Thank you.
Good morning. Thank you all for joining us in this session today. I know there was some confusion over which session, but I'm glad you chose to attend here. We're going to spend the next hour or so talking about taking a closer look at what is one of the more controversial issues of healthcare reform for employers, and that is the employer mandates. These are certainly the provisions under healthcare reform that are causing some great stress to employers. So I want to walk you through the presentation today. Is going to walk you through some of the key concepts, and at the end we'll talk about some next steps you should think about. If I can get the power, there we go. As you know, as I'm sure you know, the employer shared responsibility provisions take effect on January 1st of 2014, so we're coming up on that deadline pretty quickly. A key thing that you'll want to note is that these provisions only apply to applicable large employers. That's a defined term under healthcare reform, and we're going to talk about that. Healthcare reform in general and these provisions, they do not mandate coverage. You don't have to provide coverage. You've never had to provide coverage to your employees. But what these provisions do is they impose some pretty substantial penalties on employers who choose not to provide coverage to a certain demographic of their workforce, or if they do provide coverage, if the coverage doesn't meet certain standards. So while you don't have to provide coverage, the IRS is certainly going to impose some penalties if you choose not to. And obviously that's the reason it's causing a lot of stress for employers. What we're dealing with right now is we have proposed regulations that were issued earlier this year. The regulations are proposed, they are not final. Just kind of give you some overview of what that means is we are able to rely on these proposed regulations right now, but keep in mind that there was a comment period that just recently ended where people could write in, employers could write in, others could write in with comments and questions to the IRS. They take those under advisement. There's supposedly going to be an open public forum in April sometime. I haven't received the date of that yet. And then at some point in the future, the IRS will issue the final regulations that will be the final version until they decide to change it. But the good thing is we are allowed to rely on these proposed regulations. We understand that they may change, but I think they give us a very good snapshot of what we're going to be dealing with going forward. Kind of a roadmap for what we'll be doing today. We're going to first talk about the definition of full-time employee. As I'm sure you're all aware, that's been a big issue under PPACA. I refer to healthcare reform as PPACA, so if you hear me, that's the Patient Protection Affordable Care Act. So if you hear me reference that, you'll know what I'm referring to. We're going to talk again about who's an applicable large employer and how you make that determination. We're also going to talk about the potential penalties that you could be facing in 2014 and beyond and how to calculate those penalties. And we will also talk about some key defined terms under these provisions, that being affordability, minimum value, and there'll be some others that you'll hear. So we're going to talk about those as we go forward. First, we're going to look at the definition of full-time employee. I want to spend a minute talking about this because I'm sure, as you've all heard, it's a departure from the norm, from what we normally think of as full-time employee. For purposes of the employer's shared responsibility provisions, full-time employee means 30 or more hours of service per week, or a monthly equivalent of 130 hours of service per month. Now, a lot of employers thought 40 hours of service was full-time, and 30 hours was, quite frankly, part-time prior to these provisions. So this has been a key aspect of the provisions that employers need to think about. That's the general definition. I just want to point out, and it's stated in the slides, that the definition of full-time employee is the same throughout for purposes of the employer share responsibility provisions, but that term is used in different ways, from when we're talking about who's a large employer, and then when we're talking about who's a full-time employee for calculating your penalties. And we're going to talk through that, but just keep in mind that anytime you hear me refer to a full-time employee, I'm talking about this definition here. Now, when we talked about hours of service, I said it's 30 hours of service a week or 130 hours of service per month. That's a key thing to remember. I'm talking about hours of service and not just hours worked. I point this out to you because in previous guidance they used the term hours worked. In the most recent proposed regulations, we found the term hours of service. And that's something you want to consider, because when you're calculating 30 or more hours of service, you're not just looking at the number of hours that the employee is actually working for you and receiving pay for their work. What you are looking at is actual hours worked plus any hours for which they are paid. So it's your vacation, your holiday, your illness. If they're receiving pay during those, layoff, military leave, those types of things are counted toward hours of service, so something to keep in mind. So what I like to tell my clients is you add up the hours that they're actually working, add up any paid time for when they're not working, but then to complicate things just a little bit more, the IRS likes to throw in these special leave rules. You also have to count any time that someone is on FMLA or USERRA, which is a military leave, or an unpaid jury duty. So you have to keep in mind that if someone is on FMLA, that's not going to work against the individual. Now, for non-hourly employees, you're going to look at the actual hours worked. You can certainly do it that way, the same as you do for hourly employees. But the IRS did give us some days worked, week work equivalencies that you can use. Typically what you've heard is this referred to as you work an hour, you get credited for 8 hours. You can do it that way. You can do, if you work one day during the week, they're going to credit you for 40 hours. Those are the days and weeks worked equivalencies. These are methods that the IRS has implemented and approved for helping employers determine the number of hours of service someone is working. One important thing I want to point out to you is that you cannot use, and the IRS has been very clear, you cannot use these days or weeks worked equivalencies to work against somebody. And in the example here is if you have an employee who works 3 10-hour days for you every week, that's 30 hours of service per week. You can't credit them with 8 hours, saying that's an 8-hour day, and thus make them a part-time employee. The IRS is certainly aware that there are potential for abuse for these rules, and they have indicated that they are going to be carefully watching those and monitoring those. Now, just some things I want to point out to you. When you're talking about hours of service, here's some rules that were built into the proposed regulations. You do not include any hours of service for hours or time worked outside of the United States, regardless of the individual's residency or citizenship. There are special rules that are quite complex when you're dealing with situations regarding a rehire or a break-in service. I want to point these out to you. Like I said, they're very lengthy and complex rules, so we don't have time to get into them in great detail today, but here's what, if you have a workforce that has a lot of breaks in service, if they are laid off, they're brought back, you want to think about these rules and consult with your legal counsel or benefits consultants on these rules, because there are certain circumstances where you have to credit time when someone is laid off, depending on the length of the time. Let me give you an example. If someone is laid off, for example, for more than 26 weeks, that's considered a break in service. So when you bring them back onto your payroll, you can treat them as a new hire. That's important, and you'll see why that's important as we go through the presentation, because when you bring someone on as a new hire, you basically have a certain period of time before you have to provide them benefits. So if that's a situation that applies to your workforce, it would be very wise to become familiar with these breaks in service rules and the options that you will have for your employees when they come back on your payroll. I pointed out here there are special rules for educational organizations. Now, I realize that this rule probably doesn't apply to very many, if any of you in the audience, but I'm pointing this out because I want to give you a kind of a glimpse as to how the IRS is moving. For employees of educational organizations, Obviously there's the summer break, for example. The IRS has said during that summer break, you have to credit hours the same as they were receiving during the active academic year. You can't use that summer break to work against that individual, and then when you average out their hours, they're a part-time employee. So they've issued some averaging rules, if you will. The reason I'm pointing this out is there is a specific section that's left blank and it says reserved in the proposed regulations. And when you read the preamble, it makes it very clear that the IRS is contemplating similar rules for other employers. So I just want you to kind of take a glimpse as to how they're working with this. Keep in mind that things are going to change and that they may extend these similar rules. I can't say what they'll look like, but similar rules to non-educational organizations. So, whenever you're dealing with a workforce that has a lot of breaks in service, unfortunately, it's very complicated and the rules are a little bit vague right now, but I wanted to just point that out to you. So now we know what a full-time employee is. Keep that in mind, 30 hours of service per week, 130 per month. Now, I noted at the beginning that these employer share responsibility provisions only apply to applicable large employers. That is a key term that you'll want to know. An applicable large employer is a defined term. You'll hear me refer to it as an ALE. That is an employer that averages 50 or more full-time employees or full-time equivalents in the previous calendar year, the previous 12 consecutive months in the calendar year. How do you determine 50 or more full-time and full-time equivalents? Full-time employees, obvious. If they're averaging more than 30, they're going to count as a full-time employee. But the key is you have to also take into consideration all of your part-time workforce. If you have a large part-time workforce, those go into the formula as well. And the formula is you add up all of your part-time hours for a month for all your part-time employees, divide that by 120, and that's going to give you the number of your part-time, your full-time equivalents. Add that to the number of the actual full-time employees, and if you are over 50, you are deemed to be a large employer. Now, if you're fortunate enough to have under 50, you're one of the luckiest people in the room, and everything we're going to talk about after this does not apply to you. And all of your colleagues sitting next to you will be very, very envious. But if you have more than 50, unfortunately, you have a lot of things to consider, and that's what we're going to start working through now. Before we move on, I want to just point out that if you have a large seasonal workforce, this also provides some complications. Seasonal employee has not been defined clearly under healthcare reform for employer shared responsibility provisions. We obviously know that holiday retail and agricultural are seasonal, but there's kind of a gray area out there, and they're working through those, and it's been very clear that that's something that's going to be flushed out in future guidance. A lot of times you'll hear the 120-day rule. If someone's working less than 120 days per year, it can be deemed seasonal. And this comes into play when you're talking about whether or not you're a large employer. When you're calculating your full-time and full-time equivalents, you do add in any seasonal employees. But the IRS has said once you run those calculations, if you are over 50 employees for less than 120 days in the previous year, and the reason that you're over that 120 is due to your seasonal workforce, they will let you back out those seasonal employees and would not deem you to be a large employer for that following year. So that's important to know if you have a seasonal workforce. Another key provision I want to point out, and this trips up a lot of employers, is the control group issue. Large employer status is determined on a control group basis. And what that means, for those of you who are not familiar with control group, they're pretty detailed rules under the IRS code, but the general rule is it's based on ownership structure. So if you're a small entity, say you only have 5 or 10 employees, but you have a parent company or a brother-sister company, as they call it, that share common ownership, the IRS is going to look at all those entities together to determine whether you're a large employer. So sometimes employers think, I only have 10 employees, I don't have to worry about this. Please consider your corporate structure to make sure that you wouldn't be pulled into these rules under the control group basis. And then there is some special transition relief for 2014 that's important to point out. An employer, I mentioned that a large employer, you're looking back to the previous calendar year. For 2014, the IRS has said you as an employer can take a 6 consecutive month snapshot in 2013 to determine whether you're going to be a large employer for 2014. It can be any 6 consecutive months. This is very nice for employers who want to make some changes to their workforce, I hate to say work the system, but you know what I'm saying there, to maybe lower some hours and limit the number of full-time employees that you have. The IRS has given you ways to do that. But obviously, as we're moving further through the year, you need to start thinking about those changes sooner than later. So that's kind of the gist of how you determine whether or not you're a full employer or you're a large employer. And if you are, all of the things we're going to talk about now apply to you. And these are certainly, we're going to talk about the potential penalties. And this is really the area that causes great concern. And this is where I like to say, please don't shoot the messenger, because what I'm going to share with you is a little bit painful, but we will work through it, and my goal is to at least let you know what you could potentially be facing. Now, I'm going to walk through really the two main scenarios where a large employer could be subject to potential penalties after January 1st. I'm going to read through this. There's a lot of defined terms in here. Rest assured, we're going to break it down. But here's the first scenario, and this is basically the scenario where the employer chooses not to play the game, if you will. The applicable large employer does not offer coverage to at least 95% of its full-time workforce and their dependents, and they have one or more of their full-time employees who obtains a subsidy on the exchange, goes out on the exchange, and obtains coverage. So this is the employer that's not providing coverage to at least 95%. If just one full-time employee goes out on the exchange, that triggers a penalty for that employer. And that penalty is a $2,000 per full-time employee penalty that you have to be considering. Now, you do get the first 30 free. That's the first 30 freebies, as I like to call it. So you back out your first 30, but your penalty would be based on the remaining number of full-time employees that you have at $2,000 a head. Obviously, a steep penalty. And the example I gave there is if you're an employer with 50 employees, you don't offer coverage to at least 95%, and you have and their dependents, that's key, and you have one employee who goes out on the exchange, you'd be facing a $40,000 annual penalty there. That's what I like to call the sledgehammer penalty, because it's quite steep and it hits you on all of the full-time employees. Now, the second scenario that you might be facing is this is what I like to call the play and pay penalty. This is where you are playing the game. You're offering coverage to at least 95% of your full-time employees and their dependents, but you're still subject to a penalty because that coverage that you're providing is not affordable, and that's a defined term, or does not provide minimum value, and that's another defined term. If that is the case, and you have one full-time employee who goes out on the exchange with a subsidy, you would be assessed a $3,000 penalty. Now, the difference here is that $3,000 penalty is only against each employee who goes out on the exchange. If only one goes out on the exchange, you would be faced with $3,000. If 30 go out on the exchange, it'd be $90,000. But if you look at my example, they kind of put a cap on it, if you will. So the previous calculation is your cap, and you can look at the examples to see how that works. So the first one, remember, if one goes out on the exchange, you're hit with a penalty on your entire full-time workforce. The second penalty, where you are offering coverage but it's not affordable or minimum value, you're hit with a little bit higher penalty, being $3,000, but it's only per head that actually goes out onto the exchange. So those are the general scenarios where an employer could be facing penalties. I want to go through some important things you need to know. Again, you heard me say that you did not offer coverage to at least 95% of your full-time workforce and their dependents. It's an offer of coverage. You don't have to actually provide it, meaning that you have to make it available to the individual at least once per year. You don't have to force them to take it if they choose not to take it for whatever reason. That is not going to trigger a penalty for you. Or it won't be deemed as not offering coverage to that employer, or employee, I should say. I also mentioned that you have to offer coverage to dependents. Interestingly enough, dependent means dependent children to age 26, which we're all familiar with, but does not include spouses. That was, I think, an important thing that came out in these proposed regulations. The other thing I mentioned to you is that it's a full-time employee who goes out on the exchange that can trigger a penalty for you. If a part-time employee or a dependent of a full-time employee is the one that goes on the exchange, that does not trigger a penalty for you. It is only a full-time employee. And thus you'll understand why when we talk about who's a full-time employee, that's important to know. And then there's the communication between the IRS, and this is still being flushed out, quite frankly. But the IRS supposedly, if someone goes out on the exchange and obtains a subsidy, the IRS will somehow notify the employer that that has occurred, and then it will give you, the employer, a chance to appeal it, if you will, or to say, you know, we do provide coverage to that individual or offer coverage, and it is affordable. You have some back and forth. At least that's how it's supposed to work. Also, at the end of the year, after taxes, after all the tax documents are filed for both the employee and the employer, you will receive a communication, and I like to call it a demand letter from the IRS, where they're going to say, here's your penalty for the year. We have heard that there will be some opportunity, obviously, for the employer to appeal that, to say we shouldn't have any penalty, or it shouldn't be so high, or whatever, but it's going to be you know, some communication that has to be worked out with the IRS. We don't know exactly what that's going to look like, but in the preamble to the proposed regulations, this is what's alluded to. So there will be an opportunity for the IRS to, and the employer to communicate with the IRS. Now, I mentioned to you what will trigger a penalty is you have a full-time employee who goes out on the exchange with a subsidy. So let's talk a minute about what it means to who's eligible for a subsidy. An employee with a household income of less than 400% of the federal poverty level, which is currently, and this number might be a little bit dated, that might be a 2012, 88,200. That is the threshold. Also, the individual is eligible for employer coverage, but that coverage is not affordable, and we're going to talk about that next. And also, if the coverage does not provide minimum value. If these criteria are met, the individual is eligible for a subsidy, and that could potentially trigger a penalty for you as an employer. So one of the key defined terms that play into these employer shared responsibility provisions is affordability. The general rule, and bear with me because there's a general rule and then there's some safe harbors. The general rule is that coverage will be deemed to be affordable if the employee cost for self-only coverage does not exceed 9.5% of their household income. That was the general rule originally. I point out that it is self-only coverage regardless of the coverage that the individual is actually enrolled in. And it is self-only coverage in the lowest cost option if you offer multiple options that provides minimum value. So those are some key terms you want to think about there. Now again, it was household income. That's what we were originally faced with. Realizing that it's very difficult for an employer to know household income, and typically that's not information that the employer wants to get into, finding out how much spouses make or dependents make. The IRS has issued 3 safe harbors, and this is, I think, where most employers are going to go. The 3 safe harbors is you're still working with that 9.5% number, but you take 9.5% of the W-2 wages. That's your first safe harbor. I think as a knee-jerk reaction, a lot of employers thought, simple enough, I'm going to use W-2 wages. I want to point out to you to be cautious of that, because if you're using W-2 wages, keep in mind that that does not include any pre-tax contributions to a defined contribution plan or an FSA or a 125 plan. Keep that in mind because you're actually lowering your base, if you will, if you're using a W-2 wages, potentially, if you have employers that make a lot, or employees that make a lot of pre-tax contributions. So you may not want to go this route because that's going to lower the amount for affordability purposes. I think most employers will maybe go the second safe harbor, and that's the rate of pay. And that's where you take 9.5% of the employee's rate of pay. If they're hourly, you take their hourly rate times 130 hours per month, that's your rate of pay, and calculate the 9.5% based on that. If they're a salary, you take their monthly salary and base it on that as well. The only caveat to rate of pay is you cannot use that safe harbor. The IRS said you cannot use that safe harbor if the pay was reduced during the year. If their salary was reduced or their hourly rate was reduced during the year, they will not let you use that rate of pay for purposes of affordability. The third safe harbor is a federal poverty line safe harbor, where you basically take 9.5% of the single federal poverty level. So those are the calculations that you have to work with. Obviously, as an employer, you need to run the numbers and see what works best for your workforce and determine which one will give you the most beneficial result as far as determining affordability. Affordability, if I want to point out as well, is determined on an individual basis, meaning that, while you can certainly take your lowest wage earner and base 9.5% on that, and that's going to obviously make it affordable for everybody, but it is truly determined on an individual basis. But with that said, you can use different safe harbors. The IRS will permit that, but you have to do it on reasonable classification. You can't just have, Julie in accounting, you're going to do W-2, and, Bob in IT, you're going to use rate of pay. That's not a reasonable classification. You could use hourly salary employees, certainly geographic locations, union, non-union. Those are the typical reasonable classifications that the IRS permits. So I can't be just kind of arbitrary, but keep in mind that you do have some determination there that you can make and work it in your favor as much as possible. Now, minimum value, that's the other defined term I want to spend just a moment talking about. You've heard this term a lot. This is really a measure of the cost sharing under your plan. The plan will be deemed to be minimum value if the actual cost of the, their actual cost is the actual allowed cost of benefits is paid at 60%. This is the bronze level plan we've been hearing a lot about. That's really what we're talking about when we talk about minimum value. While it's very easy for you to calculate affordability, it is probably a little less clear whether your plan provides minimum value, and I think this is where you're actually going to be working a lot with your consultants, with your insurance carriers to determine what is the bronze plan and what will meet the minimum value. There are three calculators or three approaches for determining minimum value that the IRS has issued and or will be issuing. There's going to be a minimum value calculator that will be available where you're going to plug in cost sharing information on your plan, and it will basically tell you whether it's minimum value. There'll be some design-based safe harbors that you can potentially use. And also, if you have an atypical plan, they will allow some form of an actuarial certification. Real quick, I'm only going to spend a moment on this. If any of you have a union workforce and you're participating in a multi-employer plan, the IRS has talked about this a little bit and said that if you are an employer who has to provide coverage to your employees through a participation agreement in a multi-employer plan, that will be deemed to be an offer of coverage. Even though you're not typically, or you're not actually providing the coverage, you have to do so through a participation agreement. The IRS will look favorably upon that and will deem that to be an offer of coverage. Just quickly want to point out to you, if you are working with a multi-employer plan, obviously as an employer, you are not the one running the plan, but you are not off the hook based on liability. If that multi-employer plan does not provide affordable coverage or minimum value, you as the employer, the participating employer, will be hit with the penalty, not the plan. So keep that in mind. So you need to be a player in those plans now and be, receive some kind of guarantee from the union or from the trustee as to the type of coverage that's being provided. So if you participate in a multi-employer plan, you might want to spend a little time learning more about those rules and kind of how those play. I have had a couple clients who had the initial thought that multi-employer plans were not subject to these rules, and they very clearly are. So I just wanted to point that out to you. And I'm glad that you have a copy of the slides, because this is just a handy chart. I'm not going to go through it. It kind of talks about how you apply the definition of full-time employee in different scenarios under the employer shared responsibility provisions. And you can certainly look at that at your leisure. So how do you determine who's a full-time employee for penalty purposes? This is where the rules, if you don't think they're complex already, they get really complex. I just want to recap for a minute. Remember what we're talking about when we talk about full-time employee. Remember that only a full-time employee triggers a penalty for you. The original rules, when they came out in the Act, envisioned that you would calculate employees on a real-time basis. That's the IRS for you, thinking that employers can just calculate this as we move forward, add and drop people from the plan, every month. I mean, clearly that is an administrative nightmare. Thankfully, they realized that at some point, and therefore they issued these safe harbors. And that's really what we've been hearing about. These are the measurement periods, the look-back periods, and I really think that's where most employers are going to go. I have yet to come across an employer that wants to go through the painful exercise of determining this looking forward month by month. So the general concepts, and we're going to talk about them, is you're looking back. You're looking back at your employee workforce to determine who's a full-time employee going forward. Kind of a strange concept, but hopefully we can work through some of this. As we talk about these next few provisions, there's categories of employees I want you to keep in mind. The first is an ongoing employee, and that's just an employee who's on your payroll, who's been on your payroll for some time. Obviously, they're not a new hire. The second one is a new employee, a new hire, who is reasonably expected to work full-time. We also have this concept of variable hour employee, and that is an employee, when they are hired, you as an employer cannot reasonably say whether or not they're going to work full-time or how long they're going to work full-time. And then there's the seasonal employee, and as I've already pointed out to that's really a gray area. For now, the IRS has said that they will permit a reasonable interpretation and a good faith effort to find someone as seasonal. So we'll see how long that lasts, but until the final regulations come out, they will allow a reasonable standard. So let's look at the periods. The periods you've probably been hearing about and are trying to figure out, like everyone else, are your standard measurement period, your stability period, and your optional administrative period. So we're going to look at each one of those. The first is your standard measurement period, and this is really the period when we're talking about ongoing employees on your payroll. This is what I like to call the look-back period, and that is where you are going to look back over a period of time to calculate which employees averaged more than 30 hours of service and would be full-time. Your period, your standard measurement period can be at least 3 months, has to be at least 3 months, but cannot be more than 12 consecutive calendar months. You do have some flexibility as an employer to determine the length of your measurement period. You want, depending if you have a highly fluctuating workforce with hours, you may find when you run the numbers that it may be 3 months or 6 months or 7 or 8 months is actually something that works for you. You really have to run the numbers. If you have a pretty steady workforce, I think it's a little easier for you, and a lot of employers are opting for a 12-month measurement period because it's a lot easier. It's easier to administer. It kind of runs with your general plan year and how you've been administering your plans, but you do have some flexibility. Your measurement periods do need to be uniform for all employees in those reasonable categories that I mentioned a few minutes ago. So again, we're talking about union, non-union. Different collective bargaining agreements are one that they will allow, and also places of employment in different states, hourly salary. So if that works in your advantage to have different measurement periods for different reasonable classifications, you certainly can do so, keeping in mind that it's certainly difficult to administer. The next period, so you have your look-back period. That's where you're measuring, you're counting hours, you're tracking hours. Then you enter into this stability period. That's what I like to call the hold period, for which an employee's status, once you measure them during the measurement period, if you've deemed Joe to be full-time because he worked full-time during the measurement period, Joe will be full-time for your entire stability period, your look-forward period, even no matter how many hours Joe works during that stability period. Once you lock them in as a full-time or part-time employee at the end of that measurement period, they are held in that status for your entire stability period. Your stability period must be at least 6 months. And it cannot be shorter than your measurement period. So if you used a 12-month measurement period, you're stuck with a 12-month stability period. And that really might be the easiest to administer. Now, if an employee is determined not to be full-time during the measurement period, the rules are slightly different, and that is your stability period cannot be longer than your measurement period. The rules seem complex, but sometimes it's helpful for me and others to think the general spirit of this law, according to the IRS, is that everyone has health coverage. So if you've deemed someone to be part-time and thus not entitled to health care, believe me, the IRS doesn't want you to hold them in that status any longer than you have to, and they're not going to let you extend that part-time hold period any longer than you have to or that you're allowed to, because they want you to constantly track hours and make sure that anyone who maybe had a fluctuation in hours, and once you run the calculations as full-time, that they're getting that full-time coverage. I mean, that's really the general purpose of this law from the IRS perspective. And there's going to be a graphic we'll talk about in a minute that might help visualize how this. So we talked about our measurement period. That's when you're calculating. You deem them to be full-time or part-time, you enter into your hold or stability period. The next period that you've heard about is this administrative period. This is an optional period. You don't have to do this, but I think most employers are, because I like to think of this as the period where you're going to stop and catch your breath. It's kind of like your open enrollment period. You've calculated all your employees. You take a step back, you look at your calculations, you deem who's full-time, who's part-time, you make a determination as to who has to be offered coverage, who doesn't, you get your materials out. This to me would be a very important period from an administrative standpoint. This cannot be longer than 90 days, and it will overlap the previous periods, and you'll see in the graph what I mean by that. In other words, this administrative period isn't creating any kind of gaps in coverage for anyone. It's truly just an administrative period for the employer. And before we get to the image that will help put this all in perspective, to complicate things even more, the IRS has issued a special measurement period for 2014, realizing that for 2014 purposes, the employers are calculating hours right now in 2013 to determine who's going to be full-time going forward. This is what it basically does is it allows an employer to use a shorter measurement period, say 6 months, and still take advantage of that longer hold period, that longer stability period if you want to do a 12-month. Remember, the general rule is if you wanted a 12-month stability, you had to have a 12-month measurement. In this rule, you can have a shorter measurement, still take advantage of that 12-month stability going forward. This is a one-time deal from the IRS, and there are some rules built into it. The advantage of taking it, the good thing about taking advantage of this is if you want to work your workforce a little bit and change your hours of status before you start measuring, your hours of service before you start measuring for purposes of 2014, this will allow you to do so, but the window's closing and you'll see why. The rule is that you must start measuring no later than July 1st of this year, and your measurement must end no earlier than 90 days before the first day of your plan year. So what this means for you, it has to be at least 6 months in length. So if you're operating on a plan year basis, or a calendar year plan year basis of January 1st, and you're using a 30-day administrative period, or you'd like to use a 30-day administrative period, you would have to have started your calculations on roughly April 1st or 2nd. My math might be off on that, but it's the beginning of this month. So that would be in place already. Now remember, you have flexibility in determining the length of your administrative period. So if you want to move that back a little bit, you might have a few extra days here, but you would have to the point is you need to start calculating relatively soon if you want to take advantage of this, meaning that you need to make any changes you want to make to your workforce very quickly before you actually have to start calculating. This may or may not be of advantage to certain employers. I mean, for like a very steady workforce that doesn't want to make any changes, this probably wouldn't help you. But for other workforces that you either do want to make changes or that it's varying, you might want to take a look at these rules. They're a little complex, but think about whether or not this would be something that works for you. If you're operating on a non-calendar year plan, you have a little longer to comply with it. You still need to start calculating as of July 1st, but you still obviously have a little bit more time. But time is of the essence here, to say the least. Now here's an example, and I hope this at least helps flush out how this works. And all these examples are in the handout. This is an example where the employer took advantage of the 2013 measurement period. They're operating on a calendar year plan. And I just want to point out how this, I just want you to be able to visualize how these periods overlap. So you see you have your measurement period, and then you have your administrative period starting on October 15th, and that they chose a 90-day period here. And then as you'll see, so you measure during the 2013 measurement period, you make the determination during your administrative period who's going to be full-time going forward. Then you enter into the blue box, which is your 12-month stability period for 2014. What I think is important to note, and why I like to show this visual, is because it's important for employers to know that you're always tracking hours. You're constantly tracking hours. So while you're in the blue box 12-month stability period in 2014, someone at your office is calculating the hours on employees during if you look at the yellow boxes at the top, those are your measurement periods. So while you're in a hold period, you're really also in a measurement period for the following year. And then you have your administrative periods built in. I know it's complex, the rules, it's the IRS for you. I just can't imagine they couldn't have made this any easier for us, but they chose to go this route for whatever reason. But I hope that this image at least helps you understand the flow, because we've had clients who basically think they have to calculate once and then they're done, and we have to remind them you need to have someone dedicated to this, a team maybe dedicated to this, to constantly tracking hours. So hopefully this will be a helpful tool. And then the next example, and it's all in your handouts, is if you have a fiscal year plan and you still want to take advantage of this measurement period. This will kind of give you some ideas of the dates that you'd be working with if you want to go that route and you're on a fiscal year plan. Now here's an example of ongoing employees. I'll walk through this relatively quickly because, again, you do have them in your handout, but this is similar. This is going forward. This is saying, once you determine for 2014, this example is going to look a little further in the future where you're not using a special period. I think this will help flush it out for you. This employer chose a standard measurement period of October 15th through October 14th. This one, I'm sorry, she did do the 12 months. But this is, and then they're going to use a stability period of January 1st to December 31st. So they're using a 12-month. And they're also going to do that administrative period. They're going to choose 90 days. And I think that's what a lot of them, this will be a pretty good snapshot of what a lot of employers are going to do. As you can see, you're going to have the 12-month measurement period. You're also going to then determine who's full-time. They'll be full-time for the entire 12-month stability period, and it just keeps rolling forward. And as you can see how these periods flow. And this one, as the indicator is there, you can tack this onto the previous chart and you will see how it works. The first chart was a good snapshot of what it looked like if you want to use the 2013 special enrollment. Put this one on the end and this will kind of project it forward for you. This is a relatively simple example because it's using a 12-month measurement stability period, but hopefully will help you work through that. Now that was for ongoing employees. I mean, the fun isn't over here. Now we have different categories. You remember I talked about different categories of employees. What about your new hires that you're bringing on? If you have a new hire who, as an employer, you are reasonably certain they're going to work full-time, you don't really have to put them in any kind of measurement or stability period. The rule is if they're going to be a full-time employee because of category, and you can say so, you don't have to offer them coverage for the first 90 days. That's allowed. But as of the 91st day, if they're on your payroll and they're a full-time employee, you have to offer them coverage. If you fail to offer them coverage, then you will be deemed to not have offered them coverage dating back to their date of hire. So what do I mean by that? If as of the 91st day they're full-time and you're not offering coverage, they're going to fall into those two scenarios that we talked about previously, and you can better believe the IRS is going to slap on a penalty dating back to their date of hire. They're not going to grace you 90 days here on your penalty. They're going to go right back to the date of hire, so that's important to know. But it's a little easier if you have someone who's hiring in that's full-time. There's really not a calculation that has to be run there. But it does get tricky if you have someone hiring in who's a variable hour employee or a seasonal, and they present all kinds of unique challenges. You basically are going to start measuring them via a special initial measurement period, and in the interest of time I won't go into too much detail here, but you start calculating hours as of date of hire. What it means to be a variable hour, I want to remind you, is that someone, when they hire in, you cannot reasonably say that they will be working full-time, or you don't know how long they'll be working full-time. The IRS is allowing you to deem them a variable hour employee. And what that basically means is you do not have to provide them coverage at the time of hire. You actually, when you think about it, really get almost a year grace period, if you will, if you choose a long measurement period, because you start measuring their hours, and then at the end of your measurement period, you would then have to determine whether or not they're full-time and offer them coverage. I caution you here, obviously there's some room for abuse here because there's a reasonable standard. Anytime the IRS uses the word reasonable, it makes me cringe a little bit as an attorney because that, of course, is not defined and there's a lot of potential for abuse. But if you truly have someone hiring in and the hours truly are variable and you know for certain that you can't say they're going to be full-time, then you can deem them to be variable, and it does buy you some time. For lack of a better way of putting it, it buys you some time to have to offer them coverage and gives you a chance to determine exactly what their work level will be for you as an employer going forward. And then there's an example, and I'm at your own time let you walk through the example of how this will work, and it kind of plays through how the employer starts measuring at the date of hire, and then how you determine whether or not they are going to be full-time moving forward. So if you don't mind, I'm going to skip through a couple slides here so we can get to some other important topics that I want to talk about. I'm going to stop here. When we talked about variable hour employee, it's helpful to think about it this way. When you hire someone as a variable hour employee, you have a special initial measurement period that you're going to choose, and you're going to measure them kind of on a different cycle. But the ultimate goal is to transition any new hires onto the same measurement and stability periods as all your ongoing employees. It's a catch-up, if you will. So there's some rules, and there's some examples in the slides as well as how you catch your employees up. But eventually you want to have have them on the same cycle, so you're not having different measuring periods for all your employees. So that's going to be important from an administrative standpoint. Stepping back now and talking about how you determine full-time employees, I just want to switch gears a little bit and talk about staffing agencies. I don't have a lot to tell you about staffing agencies because the rules are still being flushed out, but they certainly provide unique challenges to employer share responsibility, among many other employment regulations and rules, but certainly under these rules as well. The IRS has requested comments on staffing agencies and how it should be treated, how you should treat the employers for purposes of common law employee status, and we'll see what future guidance holds. But what I can tell you is, when they're talking about common law employees, if you can say that the employee is a common law employer of the staffing agency, and as any of you know who deal with these, common law employer is a gray area to say the least. But if it's a common law employer of the staffing agency is the employer for purposes of these employer shared responsibility provisions, and they would be the ones who have to offer coverage, and they would be the ones who would be subject to these penalties. But again, common law employee is a very subjective analysis. Tread carefully here if you're dealing in these circumstances. What I have seen a lot of staffing agencies are, believe me, they're going to try to recoup some of the costs from employers. They're doing this through either direct bill. We've seen a few direct bill situations in contracts, and of course an increase in the bill rate to try and capture some of the costs for potential penalties. If you're working in these circumstances, think about that and keep that in mind, that that's certainly something that you may be facing. But if you are working in the staffing agency realm, or you have staffing agency individuals on your workforce, you want to stay tuned, if you will, because I do think that the IRS is going to flush this out some more. Now, some of you might be operating on a non-calendar year plan. If you are, there's some transitional relief as far as the effective date of these potential penalties for you. There's some rules here. The non-calendar year plan had to be in place on December 27th, kind of an arbitrary date, but that's what they chose. In other words, you can't put one in place now and say you've had it and then therefore take advantage of a delayed effective date, but you had to have a plan in place. The plan also had to be offered to at least a third of your entire workforce, full-time and part-time, in the last open enrollment period, or had to cover at least a quarter of your workforce. And those rules are in this slide here. But what this basically means, if you can meet these criteria and you're on a non-calendar year plan, then you would not be subject to these penalties to the first day of the plan year after January 1st of 2014. I have a lot of clients who operate on a July 1st basis as the start of their plan year. As long as they're meeting these criteria, they technically don't have to do that offer of coverage until July 1st. 1st of 2014. That is some transitional relief that has been issued by the IRS. Determining plan year is a whole other issue we could talk about for a long time. We won't get into that now, but you need to be very clear what your plan year is. Anyone who's subject to ERISA and has plan documents, that's a pretty easy determination. I have a lot of difficulty when I'm dealing with clients who are not subject to ERISA, such as a school group, for example, who don't technically have plan dates or plan documents that specify the plan year, and that's where it gets a little sticky, and you need to be very careful about what your plan year is. But if you can say it's a non-calendar year plan, so you might want to take advantage of these rules as long as you can fit within the criteria. What I want to point out too is next steps. And this is important for you to step back and think about, because these rules are really right around the corner. January 1st, unfortunately, is not that far away. These are the steps that I like to take when I'm dealing with an employer group. First of all, first and foremost, determine whether you're a large employer, and if you're not, again, you're very lucky and you can not be concerned about all these rules. But remember the control groups. That's key, and that has caught up a lot of employers that I've been dealing with. Also determine your full-time employees. As you know from everything we've just talked about, that is not an easy analysis, but determine who your full-time employees are. Conduct an analysis of your organization's health plans to determine which ones are even subject to health care reform. As you know, limited accepted benefits such as limited scope dental and vision and certain retiree-only plans are not even subject to these. And they're also, you want to take a look at your actual, your health plans in existence right now. For example, do you provide coverage to or offer coverage to at least 95% or more? If not, you're going to have to think about doing so or face the potential penalties. What about dependents? A lot of employers are not providing coverage to dependent children to age 26. Remember, that could trigger a penalty for you as well. We talked about affordability. Start running those numbers on your, take a look at the cost of employee-only coverage for your lowest cost plan. Is it going to fit within that 9.5% threshold? And is your coverage affordable? Or are you going to have to make some adjustments to that? And then what is the cost going to be for doing so to you? Similarly, the minimum value. If your plan does not provide minimum value, that could also subject you to penalties. So you need to start working with your consultants to determine whether or not your plan does provide minimum value. Certainly review your current workforce to determine who is a variable hour or who is a seasonal, and how you're going to treat those individuals, and take heed of the special rules that there are for those. Of course, then we get into the whole measurement period, start looking at the numbers to determine what measurement period is going to work best for you, what stability period is going to work best for you in your industry, and certainly produce the best results as far as the penalties are concerned. If you participate in a multi-employer plan, I mentioned those as well. Start working with that multi-employer plan administrator and trustee to make sure that that coverage is affordable and provides minimum value, or that could trip you up and provide penalties to you as well. Anyone working with unions, I always recommend, if you're negotiating a collective bargaining agreement, try and get a reopener in that bargaining agreement, a limited scope reopener that will allow you to reopen the contract going forward for specifically healthcare reform related issues. There are so many unanswered questions right now that if you can work this into a collective bargaining agreement, it's priceless, because you want to be able to reopen negotiations should things change. Easier said than done, I know, when you're working with a union to try to get this put in there, but we have had success in some circumstances, and I think it's a very valuable tool. Consider workforce restructuring, maybe or maybe not. That's something that you might want to consider, but now's the time, because of all the dates we talked about, and time is of the essence, that you would want to think about any kind of workforce restructuring. And by that I mean lowering people's hours to make them part-time, bringing on more part-time staff instead of full-time, et cetera, et cetera. And then make the decision whether or not you're going to continue to offer benefits at all, or you're going to do pay the penalty. I don't endorse it one way or the other. That's a very subjective business analysis, but it's certainly something that businesses are considering right now and running the costs on that to determine what works best for them. And I think that's all I have for you today as far as this presentation. I hope you found it to be helpful, and I think Jennifer has a few words about Healthcare Connect.
I think we do have a few moments, maybe just to take a question or two. Is there anyone in the audience that wanted to ask Kristi a question? Okay.
Kristi, just a question related to the calculation of the household income. Mm-hmm. Is the way the regulation or the rule is written now, will that include income from dependent children under the age of 26?
It does. Is this on? It does, yes.
Any other questions?
Kristi,
yes.
The analysis for penalty in terms of the offering 95%, or is it all or not? I mean, one of the criteria or all three of the criteria, or just two of the criteria that makes you subject to the penalty?
It is, well, it's one of the three. I mean, we have to be under the 400% and unaffordable, or under the 400% and minimum value. It doesn't have to, if your coverage is affordable but does not provide a minimum value, that's still going to trigger a penalty for you, and the same is in the reverse.
Anyone else? Starting.
With regard to the 95% people that you offer coverage to, how would you offer coverage to 95% and not be run afoul of discrimination rules such as 105H?
That's a great question. Let me answer two different things. When I say the 95%, the IRS has said that, and I'm going to get to your question, but the 5% can be either purposeful or it could be inadvertent. So they've kind of built in a cushion there, but you can also purposely exclude 5%. And that's getting to your question, sir. The 105H rules are something that everyone needs to consider. Right now, self-insured plans are subject to those rules, and that is in those rules, for those of you who aren't familiar, and I'm speaking very generally, is you cannot discriminate in favor of highly compensated or key employees. That's the general rule, although there's much more to it. That self-insured plans are subject to those rules right now. Fully insured plans today are not subject to those rules, but they will be. Healthcare reform is closing the loop and is going to subject full-time or fully insured plans to the same or similar non-discrimination rules as self-insured. The effective date for that, however, has been delayed. We do not know when that's going to come out. There was original guidance that made it seem like it was going to be 2014. It is not, and the IRS has said it's basically because they couldn't get it together in time and couldn't release the regulations. So I can rest assured that it's going to be something to consider. They have said that they would give us a 6-month notice, if you will, before they actually go into effect. But that's something that you will want to consider. If you are excluding either purposefully or inadvertently 5%, if your plan is going to then benefit the highly compensated, that's a whole nother analysis that's going to have to occur, and further changes to your plan would have to occur as well.